Just before I start, because there would be a few people who don't know me personally. So I am Prashant Narang. I'm a chartered accountant with 24 years of experience post qualification. And I worked with, in the start of my career, I worked with PricewaterhouseCoopers and Delphi. And then I was in practice, CA practice for a very long time. And I've been working with SMEs, on their financial management uh, part in terms of managing it better for many years now, and have been helping businesses do that part better. So I'll just set the agenda for the webinar. That is, we'll be understanding why one should focus on accounting and finance, and what is the difference between profit and cash profit. Uh, Many people don't understand this difference, and in this uh, the misunderstanding, I would say, there is a eventual loss that the business incurs, and one has to be really aware about this aspect. Then contribution analysis, uh, what we can do to increase our margins, and uh, what products to sell, what clients to serve. One can actually analyze and concentrate better on those products or clients. How budgeting and monitoring can be used to enhance the profitability, and maintain the profitability, or enhance the profitability and better the cash flows. And then few hidden gems that are there, areas where our profits or our cash flows get stuck, and we can easily find them out, and we can work on them. So if businesses fail, we all know businesses fail. If any business fails, then what could be the possible reasons? If you can put it on chat, or you can unmute yourself, you can give me a couple of reasons, maybe more reasons, what you think is is the major cause of any business failing. You can put it in chat, you can unmute yourself, you can.
They run out of cash.
Yeah. Lack of sales, mismanagement. Yes. Okay. So there could be many possible reasons, for businesses failing. There can be change in, government policy. Suddenly your business might become illegal. There could be, a change in the competitive space. There could be a, competitor coming in and totally disrupting, the competitive landscape. And there can be a technological change which can make your business redundant. There can be labor unrest. There can be a lot of things, that lead to a business closing down, or failing. As you mentioned, lack of sales. Certain people mentioned lack of financial management. So all these reasons, are responsible for any business failing. But our research actually said that, the main reason for businesses failing, 95% cases, it is actually financial mismanagement. And rest of all the, reasons that I mentioned, they constitute the remaining 5%. So financial mismanagement eventually, leads to closure of businesses. I've seen many businesses closing down because of such basic errors, like people did not calculate their gross margins correctly. They took a formula which was copied from their competitor, and they ignored their actual cost. And they just thought that if their competitor is earning money, with the same percentage margins, they can also make money. But in their case, the costs were higher, the volumes were lower, and with the same gross margin percentage, they actually were doing a gross loss. A lot of people don't consider the financial costs, in their businesses. I have friends who have really made those disasters in their life by ignoring the financial costs, because what they were concentrating primarily was increase in sales, or even if they were monitoring, the profit, the EBITDA, I would say, but they completely ignored the interest cost, which actually made their business really go down the drain after so many years of hard work. So just because why I brought this up was that you should understand that financial management is one of the most important aspects of running a business. It is the foundation on which the rest of the functions work. We all understand what needs to be done, but it is actually when it comes to finances, we blindfold ourselves. We go to office suited booted every day, but we're really unaware, or we are you can say blind towards the actual numbers. And that is a very sorry state of affairs, but I mean, I've seen it personally, so I really feel that people should remove this blindfold. But why business owners manage their businesses based on a certain feeling rather than looking at the actual results? So four major reasons. So number one is, as they know, they earn on each transaction, so they focus only on increasing sales. So they are totally looking at, if they are increasing sales, then it is an assumption that the profitability of the business would go up. And I have seen in numerous cases where there are businesses which would say earning, say, 1 crore profit at a 20 crore turnover level, and they were earning actually less than 1 crore at a 60 crore turnover level. And I was surprised that the business owners were not even aware. When I calculated the numbers and showed it to them, they were amazed that why they have simply missed the simple mathematics in their business. But because their focus was only on increasing sales, they forgot it. Number two reason is number two. Number two means the number two transactions which are outside the books, the number two money. This actually leads to a lack of visibility of the actual results of the business, because you really don't know, because you don't keep the record for number two transactions. uh, though as a chartered accountant, I've always discouraged people to do number two transactions, but yes, they do it. But that really deviates your the picture that your books are showing. And because you've not kept a record of the other transactions, you really don't know that what is the actual result of your business. Then lack of proper accounting. Smaller businesses or even large businesses, if they do not have proper accounting teams, uh, I mean, I've seen people giving hefty salaries to their sales teams, but when it comes to an accountant, people generally think of it as a cost center, and they would never want to hire good accounting teams. And that is where the books are not updated properly, and then when you look at your books, you don't get to see the actual result. Lack of accountability is one thing which is, I think, it's number four reason, but it is actually the number one reason, because people are not uh, answerable to anybody. When we are running our own businesses, we are our own bosses, and because there is no accountability to anybody, uh, that is where I would say people think that whatever they are doing, it is fine till the time they have enough cash to take care of their business, their households. It is actually when there is a cash crunch situation that people turn around to look at their books to see what exactly is going wrong. So these are the prime reasons why business owners don't look at the actual results. This is my opinion. People who agree with me, you can put it on chat that you agree with these points and you face similar challenges, or somewhere you can resonate that you also shy away from figures because of these reasons. So financial management is as I said, very very important, very very important from a perspective of keeping the business going. So but we need to understand what is the difference between accounting and finance, because people generally mix the two terms. And They think that accounting and finance is the same thing. So without, asking you to define it, I've just put the definition here. So accounting is just an act of collecting, recording, and presenting all the financial transactions of the organization. So the ability to understand, so it is only, maintaining records. So an accountant might not be a great finance person. So when we actually hire accountants in our businesses, we expect them to have the financial acumen, but it is not necessary that they understand finance. They are good accountants. They are good at recording, and they are good at compliance. They are good at filing your returns and all. They might be very good, but we cannot expect the accountants to understand the financial implication of each transaction. So financial management is basically the ability to understand the impact of every decision you make on the organization's profitability, and then to ensure that you take all those actions that will strengthen the bottom line and do nothing that weakens it. So I always say that people they tend to undermine the impact of their actions on the profitability. So even the business owner as well as the team, they don't understand, when they are taking decisions on a daily basis, how it is impacting their bottom line, so the bottom line of the business. So it is about, say, the purchase guy not negotiating well with the vendors, not taking the quotations as required. The I would say their action has a direct impact on the bottom line of the business. Now, who will understand these aspects? So it has to be a person who can understand finance. There has to be a person in the business who highlights these points to all, the decision makers. Uh, I mean, I give a very small example that, if your office boy is making, you ask them to make 2 cups of tea, and every time you ask them to make 2 cups of tea, he makes 4 cups. Every time that those 2 cups that are going waste, they are actually an impact on the bottom line. Now, if somebody is monitoring it, and then highlights to this office boy that, this small act of yours is, weakening the bottom line through a very small extent, though, the person would stop doing those things. So one is, having a person in the team who's focused on this aspect, and second is the, educating those team members that how their uh, actions are impacting the profitability and cash flows of the business. So this is my favorite analogy. So how many of you love cricket? If you can put in the chat, how many of you love cricket? I mean, we are a cricket loving country. I'm sure many of us love cricket. Yes, live watching. Huh? So definitely. So all of us love cricket. So I ask a question to everyone that if there is a cricket match which is coming on the screen, there is no score, and you can't, hear the commentary, and you in under no circumstances you can know what is the score going on. How many balls are left or how many runs are to be made to win the match. How many of you would still watch the match? I think Mudit meant not me. Yeah. So it will not make sense, till the time we see the scoreboard. Yes. So I always ask business owners that if you will not watch a match because the score is not showing on the screen, or you anyways you cannot know the score, you will not watch the match even for 5 minutes. It is, you it will there is no interest in watching the match. But the game that we are playing on a daily basis, every day we uh, you know get ready and we go out and play our game of doing the business, but we forget to, look at our scores, how we have played, how many runs are needed to win the match, or how many balls are left. We really don't know. We are clueless about it. The only number probably what people monitor is sales. And I remember in a BNI meeting, there were 100 people, and I asked those 100 business owners that how many people know the last month sales. I think 15, 20 hands went up. Then I asked how many people know the last month's profitability. So only three hands went up. And then I asked that how many people know last month's cash flows, in terms of how much cash your business has generated. No one raised the hand. So we as business owners, we cannot watch a cricket match for 5 minutes if the score is not showing. But probably we have been living our lives, running businesses for years and years, and we don't know our score. So it is time that we start looking at our score, and make it more interesting and meaningful, and so that our direction is also clear, that we need to score these many runs to win the match. So how many of you resonated with this, and it has really made you thinking that you have not been looking at your numbers? If anybody has anything to share, or a question, you can you know pause me and ask. Rest share your feeling. Okay. So now, what is the most common problem of all business owners? If I can have some inputs. Yes, Dr. Sneh.
Yeah, at least in my business, it's lack of a big team. Like, many things I'm doing, or a few people, limited people are doing. So, say a finance person, accounting person, lack of that is a hindrance.
Okay, and why is that? Why don't you hire people?
Right now, we are not as big, and so yeah, that's the challenge, I guess.
Okay.
So I guess we don't expand before time, and we wait for those opportunities, and we don't grab some opportunities because we are not as big. So I guess that's a big problem for us, because sometimes there are good orders, the good big orders, and we are not able to catch them because we think that we don't have the right people, and we don't get the right people before we have that job. So and when if even if we get that job, हम वो job order ले लेते हैं, then at the time of processing that job, we don't get the right people at that point of time.
Okay.
I think one problem is that good projects sign up, अच्छा projects चल रहा है, fee आ रहा है, लेकिन वो पैसे दिख नहीं रहे कहाँ है, because they come and go before they come.
Yes. So thanks, Rajat, for highlighting that point that I wanted to make. So it is actually, all business owners, after putting so much of hard work, uh, and doing great projects, doing great sales, they are actually, they don't see the money in their banks. So there are few statements which I have heard most commonly. We took loan and we are still struggling with funds. I have pumped in so much of money. Where has it gone? Sir, month end is approaching. We need money for salaries, other expenses, and yes, vendors also. Bank overdraft is fully utilized. Let's arrange a temporary enhancement from bank. Can we get another loan from somewhere? So this is, I have seen most of the uh, you know business owners, eventually they get stuck. They lose opportunities because they do not see money in their bank. They lose opportunities because of not having a team, because eventually you feel that your business is not as profitable, or you do not have the budgets to actually pay those salaries. Because if you manage your finances well, you can easily hire people, execute projects, take up big orders. You can do all that. But yes, we need money for that. So there, the importance of cash profit comes in. So we all uh, know that when we are doing sales, we are making money. There is a profit that is showing in the profit and loss. I mean, I have had numerous discussions with the business owners where they say, "Ki sir, इस साल 1 crore का profit है, but bank में 10 lakh है." And in one case, it was a case of a HVAC guy with a 75 crore turnover. They made 10 crores net profit as per the P&L, but their cash profit was negative. So I'll show you how, but it was actually a case where the guy saw his P&L, 10 crores profit, and he went and bought a Mercedes. And when I showed him the calculation of his cash profit, I said, your business hasn't generated cash this year, and you have gone and bought a Mercedes, and you're now paying the EMI. So what you've done is that already the situation was, not good in your business. You've made it even worse by, buying a non-productive asset. The Mercedes is not going to contribute anyways to the profitability of the business. And now the burden of the EMI is also there on the business now. But because he saw only the profit figure, that is how the decision was taken. So it is very, very important that our profit and our cash profit, they are, almost equal. We need to ensure that whatever we have earned as profit actually comes into our pocket. And we know what we have done, then we should know what we have done with that money. So profit is primarily, sales or income minus expenses, whereas cash profit is money collected from customers minus payment made for purchases, expenses, and taxes. I've made a very simple, uh, you know, uh, you can say simple equation this is. But yes, when you go back in your businesses and you apply it, it might not be as simple as that. But, more or less, conceptually, it is this only. So whatever money came in minus whatever, payments you have made, whatever you're left with is, the money that you have. Suppose if the money collected from customers, so if you have done some sales but the money hasn't come in, it is very much possible that you have made a profit, but in your cash profit equation, the cash profit is negative because the money hasn't come in. And it happens with almost all of us. So this is something which is a very common phenomenon, that we keep increasing our sales, we keep selling on credit because there is a large customer, there's a large company, a large order. We would give credit, but our payments for purchases, vendors, expenses, taxes, everything is to be done today. So we end up paying for that, those costs and those taxes in, say, today's time, but our money collection is going to happen in the future. So I'm just giving you an example. So one, part is to find the difference, and then is to analyze it. So I've just given an example. So suppose profit as per P&L is 10 lakhs. Now, suppose if you have not paid for certain purchases or expenses, it will increase your cash flow. So you have added it. But if there is an increase in receivables or debtors, that will reduce your cash flow. So I've just, reduced what reduces our cash flow. I've, deducted it. So increase in debtors and increase in inventory. Suppose if you made a profit of 10 lakhs, but you went and bought more raw material for your, production. So to that extent, your cash uh, profit has gone down. So that is where increase in inventory and increase in debtors reduce the cash flow. And whereas if we hold back certain payments, it will increase the cash flow. But in this particular example, 10 lakhs is the profit as per, the profit and loss account, which your accountant might show you. But you actually look at the cash flow, the cash profit is minus 3 lakhs. And this was exactly the case in, that HVAC guy who had a 10 crore profit here and a minus 1.5 crore cash profit. And, you know, once he was aware of it, his entire behavior changed. He suddenly was focused how to correct this situation. So till the time you're aware of, what is going wrong, where the money is stuck, you will not know what to do. So for that reason, you should prepare a cash flow statement, which is very, very important. So why it is, important for us to know the cash flows is that liquidity and availability of funds is critical to the existence of any business. This is something which, uh, I mean, it is self-explanatory. We all need funds to run our businesses, expand our businesses. We need that. Interest costs eat up the profit. So suppose if you have to put in money in spite of earning a profit, you have to still finance your business, say by borrowing from bank or from a friend or anybody, and you're incurring an interest cost, that interest portion will be reduced from your profit. So the more money that gets stuck in the business in form of debtors and say stock, when your cash profit is lower than your profit, this interest portion will reduce the profitability. So when I said profit and cash profit should be same, it is also to keep the profit intact, because when the cash profit is low, it eats up the profit. So consistent low cash profits can lead to lower net profit in future, bad debts, and obsolete inventory. So we don't realize when we give too much of credit or we don't follow up on our collections, it actually results in bad debts in the long run, which reduces the profitability in future because we'll write off that bad debt in future. A healthy bottom line increases expectations of all people, but company doesn't have funds to meet those expectations. As I gave the example of the Mercedes that the guy bought because he saw a 10 crore bottom line, but there was no funds in the business to finance the purchase of that Mercedes. So this is an acronym, seduce your business. So why I would say profits get eroded or cash profit goes down. Seduce, we all know, seduce has a very different meaning, but here it means stock, expenses, debtors under control, and that is to be done eternally. So if you really want, to take that money home that your business has, generated, you need to seduce your business. I know it is a little funny, but this makes people remember this, acronym, and that is where, people don't forget it. And if you start focusing, on, these three aspects and, work closely, monitoring them, keeping them under control, you will see over a period of time, your cash profits and your profits will be, the same, and your profitability overall will increase. So there are various ways to do that. Because of paucity of time, I've not included that in the webinar, because there is limited time that I can spend on these. But these are captured in this book, which is 4 bucket cash flow. They are available on these platforms. Uh, if you look at the tagline, it says even profit-making companies can go bust with poor cash flow. Don't let it happen to you. So this is basically, all the experience that I got dealing with the finances of the business owners. I, I've kind of tried to capture all that in this book. This was written back in 2017, 18, and it got published in 2019. So it is available on these platforms. It is a very easy read. Not promoting my book for the sake of promoting it, but it actually, you really need to understand this very important aspect of your business. Because if you do that, I mean, I have uh, business owners, who had say 50 lakhs annual turnover to 500 crores annual turnover. They have come back to me that by just focusing on these aspects that I've kind of highlighted in this book, they have actually seen a huge jump in their profits and their cash flows have become better. So, it's through the professional experience. It is not very technical. If you really want to understand, the basics of the finance, it is an easy read. It is only less than 100 pages. You can read it in a few hours, and if you don't understand anything, I'm there. You can always reach out to me and I can explain it to you. So I have actually elaborated a lot on how you can control your stock, your expenses, and your debtors. So coming to the part of contribution analysis, uh, so we should focus on high gross profit products or services. So now in this case, if you see if you do an analysis of contribution made by each product to your profits. So if you see when you sell, if you sell A product A, you actually save 20% of the sales. If you sell product B, you're saving 25%. And if you sell product C, you're only, saving 10%. Now we all have got limited resources, limited time, limited capital, limited people. And if we consciously deploy all our limited resources to only the high profit margin products, so then, uh, you know, we will end up making more money. So, so I've eliminated C from this equation. So overall profit has gone up, keeping the sales as same because my resources would be similar. If I sell more of B than C, so earlier I was selling C the most. Now I realize that, and I put in my efforts to sell B more, which is a more profit margin product. Then, here I'm making 1 lakh rupee on selling 6 lakh worth of goods or services. And now when I sell B more, then I end up making 1,45,000. So by shifting my focus towards high contribution products and services, I can actually, uh, make more money. Now there are people who have come back to me and said, "Ki sir, जो lower margin वाला product है, that product we need to sell because that lower margin product is demanded by the customer." So I fully agree that there would be uh, customers demanding more of a low margin product, but because we are busy selling that low margin product, we are not left time or resources for the higher margin product. If we really try to focus and build this slowly over a period of time, that we start trying to sell more of the B, the higher gross margin, we will see our profitability going up. I mean, when back then I was doing my CA practice, I actually saw that, which are the services where I am making more money. So it was very simple calculation. Uh, the fee that I charged divided by the time I spent, I found which are the services which are more, profitable for me in terms of that per hour earning, you can say. And then I slowly uh, discontinued those services where I was not making much money. Overall, in the longer run, my profitability increased. And, so I would say that uh, the same firm, maybe my net profit was 40% of the gross turnover. Within a couple of years, I actually made it 65% of the gross turnover by only shifting my focus. So if I can do that in services, it can be done in products, it can be done in any category, I can say. If you have any questions here, I'm ready. I can answer them.
Prashant, I
Yeah,
think Mr. Vikas Narula had a question.
yeah, please.
Vikas, sir?
Hello, sir.
Sorry, sir.
Sir, I just wanted to know that as the stock in the last जो आपका slide था उसमें you have shown that stock as a if the stock is more, it has been treated as a loss. But I think it can be treated as a profit also because somewhere you will be utilizing these raw materials or stocks or inventory in the future.
Sir, I have not treated it as a loss. What I'm trying to say is that when you are looking at your profit, uh, maybe you have made profit while selling goods, but when you invest that money into stocks for further production, that money is not with you.
Yes, that is.
So yeah, so if you actually stock a lot of goods which you might not need, so banks really ask how many months inventory you are carrying. It is actually that what they are focusing on is that you should not be carrying too much of inventory, because more inventory leads to obsolete inventory in the longer run. I mean, I have visited warehouses where I have actually asked them to segregate the inventory that is not moving fast, slow moving or dead inventory. And in certain cases, the dead inventory was put separately and it was written over there, non-moving inventory, which needs to be removed. And certain times people have, it was an overwhelming experience for the business owners where they found that there was, I would say, a majority of their inventory that was lying in their warehouse was non-moving. They had not been using it for, say, years, but it was just lying there. And when I asked them that why are you carrying this inventory, it is only because they bought it at some point of time. And now the recoverability of that inventory was so low that they would have sold it at a amount much lower than the cost also. So again, as
I
I,
agree.
yeah, so that is the point, sir. Yes, Ekansh.
Thank you.
Thank you. Thank you.
Hi Prashant sir, good evening. How are you?
Good evening. Good evening.
So mine is a little specific question. So I run a travel company, and so for us, the one of the products that is least profit making is doing flight bookings.
Yeah.
So, and when we're doing flights, there have been months when 75%, 75 to 80% of our revenue, monthly revenue, was from flights. And that is one thing that is a must do for us, because that is the point from where we start upselling our other products.
Yes.
So, how do you, what do you think, like, should be our approach here? Like, do we focus on other things only, but then the initial foundation thing gets left out?
Yeah. So what you can do is when you have to make a line smaller, it is not necessary that you erase it. You can draw a longer line alongside, and then it becomes a shorter line. You get the point. So what you can focus is that, while increasing your business, you focus only on the high margin business. So we all want to do it, but eventually when, it is about really consciously focusing on the product mix that we are selling. And when we see that, year after year, if the ticketing part is only my major percentage, then probably I'm not putting enough effort on the higher margin, uh, product. So I'll give you an example. One of my friends, he's in travel industry only, and now he's focused only on luxury travel. And it's not that if I want to book an air ticket through him, he would say no to me. But his majority of revenue is coming from high-end luxury travel, and he started focusing on, the who's who of the country, I would say. And now he has become such a big name in luxury travel that everybody wants to go through him, because the kind of experiences that he would give to people traveling through him, that you cannot find elsewhere. So he is kind of specialized in that. Now he's doing the ticketing part, which might be a smaller ticket size in terms of a smaller portion of the total revenue now, because he's selling the overall packages. So it is how I have seen him transitioning from that high ticketing revenue to this luxury packages over the last 7 8 years. And it is a wonderful journey. And one sees that his profitability, his turnover, everything has gone up. So that is the point that I'm trying to make,
Mm.
that when we start focusing on certain put our resources, our time, our effort into that, it will give us results accordingly. I hope I've answered the question.
Yes, perfect, perfect. Thank you so much.
Prashant, we have
Himanshi.
one more question from Himanshi.
Yeah.
I'll
So
read it out. She has written, when you are service provider and 1 month project gets stretched to 3 months, should this also be accounted in the cash flow?
So it is not that it is accounted in the cash flow, it automatically impacts the cash flow. So when cash flow is, the uh, money collected minus the payments made. So suppose if you had to finish a project in 1 month, and there is a person, suppose the revenue is 1 lakh, and the uh, employee cost on that project for 1 month is, say, 50,000, you're making a 50,000 profit. But if it gets stretched to 3 months and the client is not ready to increase the fee, it is possible that you've incurred a loss on that service. So the profit itself will be negative in that case, and obviously the cash flow. So a cash flow is only, again, it's accumulation of figures like profit, total sales minus total expenses, we get the profit. Similarly, total collection minus total payments is the cash flow. So it is a case where you might be incurring a loss, might be, uh, you know, or the profitability has been reduced to a very insignificant portion. So service providers definitely, people don't understand, and I talk to a lot of people who are related to the construction industry. If the project gets delayed, there is the the supervisory cost that is being incurred. The labor might not be getting paid for the days that they have not worked, but the supervisory cost eats up the profits. So that is how it is. So I'll quickly move to the other part, the next part, that is, similarly, we can have high gross profit customers or low gross profit customers. It is very, very probable that we are actually, when we are selling to a large customer, they have squeezed our margins to so low that, I mean, the absolute profit is also lower than a person to whom from whom we are making more margins. So we don't calculate these things. I mean, what I've generally seen is that the larger customers, one, squeeze the contribution margin. Second is that they are the ones who pay us, I would say they are enjoying the maximum credit period from us. And when you look at the interest cost on the money that is not received timely, if you reduce that interest cost from the gross margin made from that customer, it is possible that we are not making any money from the large customers. So again, when you do this analysis, you will get to know, and then you have to take a call that whether you want to serve that customer or not. I mean, again, as a service provider or as a trader or a manufacturer, you have to do this analysis customer wise, how much absolute profit and as a percentage you are making. It is very much possible that large customers, you're not making any profit of. Yes, so definitely, the larger the customer. So I was, in fact, sharing today with somebody that I said no to clients like Hindustan Unilever and Airtel in my early days of practice, because I realized that they are not, though they were giving me huge business to start with, but the profit margins were so bleak that I couldn't even cover my conveyance, going to these clients. So I said no. I said, if you're not letting me make money, uh, you know say on a 1 lakh monthly revenue, if you give me 10 lakhs monthly revenue, still I will not be able to make any money. So I said no to those businesses, because this contribution analysis was, for me it is easy, but most of the businesses tend to, you know they tend to kind of ignore it. They don't calculate it and are always overwhelmed by, the larger customers' needs and preferences, and they spend their lives serving them only. So you're actually running a business for them, not for yourself. How many of you are feeling that this is something in your case? It is possible. So I've established it for many businesses. The larger the customer, the lower was the profit, the absolute profit that they were making from them, as compared to smaller customers where, they were making more money. Yeah. So budgeting and monitoring, time is short, so I'll quickly go through it. So this is, the MNC way of monitoring businesses. So I have worked with large multinationals also. I've, as my clients in the CFM also, and while in job also. So this part, I think, is, one of the most critical things which helps them manage, the businesses worldwide. So if they do not use budgeting, managing large businesses across many countries, they cannot do that. But we feel, as small business owners, we feel that, this is not important for us because we know everything like back of our hand. We know. But when you actually start budgeting and then start monitoring also your expenses, you would see eventually, by following a discipline, that your profitability will go up. So it's the MNC way of managing business. Budget your expenses other than the material cost, because that is, part of the contribution analysis. So if a particular product is, you're selling it at the best price that you could sell, then how to increase that gross margin contribution is by bringing down the material cost. But but when I talk about budgeting your expenses, it is about the overheads. So electricity expenses, your salaries, your administrative other expenses. So that part, if you budget and you make a kind of a monthly budget, that okay, this month I will spend this much, this month I will, suppose if you have a budget for marketing, you say, okay, I will spend say 10 lakhs on marketing this year. Now, in what month you are going to do an activity, or you're going to spread it equally across the year, you have to budget that. And then that will give you, you know, a kind of a yardstick against which you can monitor the actuals. It is easier for SMEs to budget because the line items are fewer. So you have lesser number of expenses, less volume of expenses. So it is easier to budget because you just have to make an estimate, how you can. So it's just a format where you budgeted say 5,000, 90,000, 4,500 against all these expenses, and then you managed to see the actual and you found out the variance, and you saw that okay, salaries, I could save, but I have gone up, say on the car petrol side. So what was the reason that there was more petrol spent this month? So when you look at these numbers, you will get to know that while uh, you just had put say 2,500 for the staff welfare, why you ended up spending 4,500. So maybe there was a change in the say staff policy, where you thought that okay, every month we'll do a birthday lunch, and we'll celebrate all the birthdays in the month, and that probably led to a higher actual expense. Now while budgeting the next month, you will keep that figure. So you'll so every time you do this, one is that if you accidentally spent more, you can take measures in the next month to keep that in control. That will again help you remain, वो कहते हैं ना, चादर को देखते रहो तो उतने ही पैर फैलाएंगे. So this is something like that we have set the limit, and we will try to be in that limit. So when we do a deep level analysis, more effective results come out. So say in case of this telephone expenses here, it is 4,500 and 4,550. Now, when you do this analysis, budgeted versus actual, you actually see that in this particular case, the variance was very high, which was compensated by this number. So maybe you don't need to do anything about a saving, but you really need to look into why this particular employee, ended up spending more. Maybe he made certain international calls, he or she made certain international calls, which were personal, where that is why the total bill is more. And you can actually go back and debit that personal portion of the expense to the employee, rather than making the business bear that. So that is again adding to the bottom line. So a deeper level analysis, when you do a budgeting and monitoring, this can really give you results. And I'm telling you, people who do it on a regular basis, it becomes very easy for them, though it looks like a very difficult exercise to start with. But once you set it up, it is very, very easy. So coming to the last two things, time is also nearing. So these are couple of hidden gems that I'm sharing here, though I have a much larger list that is included in the book. But if you really want to know, we can talk it separately. But here I'm just trying to make certain points. So why I call them hidden gems, that they are there in our business, they're kind of hidden somewhere. We just need to look at things with a different perspective, and we'll find them. We just maybe need to remove a couple of stones, and we'll find these hidden gems. So one is this, the popcorn tub theory. This is about mindful resource management. When we think about our team, how effectively they are working, how well we are able to manage our team in terms of their output, we sometimes undermine, the impact of that particular, you can say, lack of management or poor management. So I came up with this, again, an analogy, the popcorn tub theory. So here, a question to you all. A cinema gets 10,000 popcorn tubs printed, at 5 rupees per tub. They sell 3,000 tubs during the month. Closing stock should be 7,000. However, on physical count, the management found only 6,000. How much loss did they bear? Quick answers, please. Quick. Nupur, you are not allowed to answer because you know the answer. Yeah, others, if it's a simple maths. Anybody? Okay. So people are thinking it is a trick question. So it is a trick question. So the obvious answer is, there are 1,000 tubs missing. So 1,000 tubs into 5 rupees is 5,000. Yes, exactly. No. So they didn't lose popcorn. They lost popcorn sales. So 1,000 tubs missing. There are two possibilities. One, that those 1,000 tubs got, they were misplaced or whatever. Or the other possibility is that those 1,000 tubs were actually sold, but the sales was not reported. So now those 1,000 tubs, we all know, we all go to cinemas. These days, the tubs cost us 300, 400 rupees. So when you multiply 1,000 with a 300 rupee, figure, you get 3 lakh rupees. So what the point that I'm trying to make here is that it is not the cost of the resource that we are deploying. It is the opportunity cost, the time that is lost by an employee, how much revenue or how much impact that those hours that are lost could have on your profitability. So when we start looking at that aspect, like I was in a CA firm, I saw that one guy can generate a revenue of say 2,500 per hour, but his actual cost might be 500 per hour. So if I say that he has lost say 3 hours, it might be only 1,500 rupees, but when I look at the revenue that is lost is say 7,500 rupees. That makes each hour very, very important. So how we can do a more mindful resource management? These are the few things. We need to make an organization chart, which is very, very important from our perspective, that we see that all the resources are well utilized within the team. There are no important roles that are, we don't have a person there, because absence of that person also is leading to an opportunity loss. And if there are too many people in a particular function, we can reduce those number of people from there and deploy elsewhere. This will again lead to a mindful resource management, leading to higher profitability. Maintaining a timesheet, especially in service businesses, as I explained, one project, 1 month cost is 50,000, but if it takes 3 months to complete it, the cost is 3 times. So we really need to monitor the time spent by people on a particular project. Scheduling and planning of production. So this is something which people generally do it randomly. जिसका order urgent है, certain things which are urgent, we will probably prioritize them. But if you really schedule things, like we schedule our day, we are more productive. Similarly, when you schedule your work for the team members, that okay, today this is what needs to be done, and it is a planned thing, it will lead to higher efficiencies, a better utilization of resources. Efficiency measurement, if we can measure their efficiency, we say that okay, a particular task is to be completed in 1 hour, you measure it. If you can do that, then you see that if it is being done in 1.5 hours on an average, you really need to tell the team member you need to be more efficient. Or if suppose in 1 hour a particular product, say 10 quantity can be made and the person is making only 5, you can see the efficiency there. And chasers for follow-up. This is where, I have been suggesting people to keep coordinators to manage, uh, do the follow-ups for the tasks. So if you have coordinators who are following up on the team to complete work on time, you will see a stark improvement in their performance. Because when we do follow-ups only, I mean, as business owners, we do follow-ups only when we get a call from the client that, they have not received the product or the service. Then we start the follow-up, and it is always a very stressful situation. But the time that is lost is lost. So again, it is mindful resource management that we have chasers to do follow-ups with our team members, and that leads to a very efficient utilization of the resources. Uh, the other hidden gem is a simple analysis of your expenses, CRE, continue, reduce, eliminate. So this can be done on a quarterly or a 6 monthly basis. If you haven't done it ever, you can do it for your business and get instant results, if you mindfully look at your expenses and decide, okay, which expense is critical to the business, so we continue that. Which expense there is a scope of reduction. Suppose salaries, you feel that uh, I can do with lesser salaries also. So this, when I suggested a particular business owner, he actually, even after increasing the business 35% year on year for 2 years, he brought down his salary costs to the same level as 2 years ago by just identifying what extra hiring they had done in the process of expanding the business. Because they were also deploying technology, so a lot of activities had become redundant for which they had people. So when they realigned their entire team based on an organization chart, they could actually reduce the salary expense. Because parallelly, there was a small increase in the technology expense, but overall, they've saved a lot of money. Eliminate, then there are certain costs which we keep carrying, and we really forget to eliminate those costs. So in our office only, we were paying AMC for fax machine for a very long time, for years, because it was such a small amount that it skipped my attention, and I kept giving that AMC, and I had stopped using fax machines after email, we started using. I mean, this is long back, but I just gave that example. So some certain times what happens is, for your business, uh, like today only I was with somebody, uh, from a fashion industry. They said that it is not as lucrative as earlier to participate in exhibitions for certain products, because now everything is available on Instagram. So he said that you start spending more on digital media than exhibitions. I was like, it is just a perspective. And there are people who have stopped doing exhibitions now, and they are promoting more online. So maybe you have to take a call based on your business, what is to be done. So CRE analysis of expenses like salaries you can reduce, hoarding advertisement. I mean, please, I mean, there is no, if somebody is in this business, it doesn't, it's just an example. So don't take it personally. Digital marketing, one has to continue. Driver salary continue, because we don't understand, the time that we save while the driver is driving. We might do a lot of other things. So continue. Fax machine AMC is eliminate. Telephone expenses we can reduce. The telecom companies keep coming up with better plans. We just need to be aware. I mean, I helped one business owner reduce the expense by almost 50,000 a month. They had a huge workforce to whom they had given corporate numbers, because they were still using such an old plan. I told them, 40%, you can save just by switching over to the new plan. He called his relationship manager, and you know the uh, the new plan was implemented immediately, leading to a huge cost saving. So water filter AMC we need to continue, considering the quality of water that we get. Similar examples. Yeah. So what are the action points for this workshop? Is one is maintain proper books of accounts, fix a date in a month when you're going to review your reports, spend 3-4 hours to do a detailed analysis, ask questions, monitor your profitability, liquidity, cash flows, working capital ratios. All these things you need to do. You will see, your results becoming better. Because once you do an analysis, you list down action points, you take action, you review the result of these actions next month, and you see that the profit that you made this month is actually higher than the last month. Do it monthly. That is very, very important, because this is something which people tend to skip. And when you see 6 months down the line or 1 year down the line, time is already gone. There is no time to take corrective action. Any questions, any suggestions, any clarifications? I mean, that's the end of the webinar. Mind your profit. I think I've just completed it in 1 hour. It's 6. Thank you. Any questions, any clarifications?
Nothing but the
One point that
goosebumps.
Sorry, please go ahead.
Nothing but the goosebumps.
That was the purpose of this webinar. So actually it is such an important aspect. I always tell people that we all want to manage our weight, but we actually get to know when we step on to the weighing machine, that we know, okay, how many kilos we have, accumulated. That we only get to know. Otherwise, it is just a feeling of, feeling that we are feeling a little full, or, it's like that. And when you buy new clothes, you find an escape route also. So it's time to get onto the weighing machine, look at your numbers. Yeah. So any best practices on improving collection? Yes. Uh, so this is basically what we generally do is that we do the collection ourselves. We call up people, or we make the accountant do the collection. Uh, if we do not have, salespeople, if we have salespeople, we'll ask the salesperson only to do the collection because they are dealing with the customer. The only way to do it is, uh, I mean, if you really want to do it effectively, have a collection person in the team whose job is to keep following up with the customers on collecting. So but because that collection person is not selling to that person, that relationship of sales is not there. That person is not the accountant. So because accountants generally are so busy with accounting and compliances that they don't take out time for collection. So if you have a collection person, and I'm telling you, I mean, again, by experience, I suggested this to somebody. They had a 2.5 lakh rupee invoice pending for 2 years with a client. They were too shy to call that person to ask for the money. It was a large company. The collection agent, the day she was appointed, she recovered the 2.5 lakh rupees in 2 days. I mean, even if her salary was at 25K, you can understand she had recovered her salary on day one. So sometimes we are not wanting to spend that money on, that role. But if your business allows and there are enough invoices, enough customers to follow up, one should have a collection person. Uh, and as I said, you can have chasers for following up with team members. That coordinator, that chaser can be given an additional responsibility of collection also. But collection has to be uh, done by a person who's not the business owner, who's not an accountant, and who's not a salesperson. So that is something which will really help you improve your collections. There are a lot of other hidden gems, as I said. So we at Tab, we are helping business owners with all these aspects of, managing their businesses better. And financial management is definitely the most critical one, as far as, my heart goes, for cash flows and, better financial management. I really love this topic, and I've seen results, phenomenal results, that, people have got. Yeah. Thank you. Yeah. Yes, you can automate follow-up also through softwares, but you can certainly, still have a coordinator, because a follow-up email or message would go reminding that person, but a call would really make a difference, Vikasji. It is worth the cost, I would say. You would see your collections becoming better. That would save that much of interest cost, that, you can recover the collection person salary. Thank you. Thank you, everyone, for participating in today's webinar. Hope you liked it. Thank you.